Hello and welcome to Advisor Gold, the missing allocation, the show where financial professionals learn the why, how, and what to help their clients own physical gold and silver. This podcast is designed to complement the training at goldandsilveradvisors.com. I'm your host, Kerry Morris, and I work with clients and run a financial planning practice every day. We've used physical metals in our financial plans for nearly a decade. And I'm here with my co-host and friend, Ryan Long, second generation in the gold and silver business and president of National Gold Consultants, which only promotes their business through a large advisor network. If you're a consumer listening to this podcast, welcome. This is not financial, legal, or tax advice. It's education, folks, and you're welcome to have your advisor reach out to us, or you can email us directly with your questions. In this episode, we answer the question, what's better, FDIC or gold? You'll learn what's going on with the supply and demand right now in the marketplace, why part of this is similar to 2008, and what does the Fed's balance sheet have to do with what's next? Now here's my conversation with Ryan. Well, hello everybody and welcome to the podcast. Kerry here with Ryan, and today we're going to answer the question, what's better, FDIC or gold? Ryan, what do you think, man?
Well, I mean, first of all, Kerry, there is a reason why there is FDIC insurance, right? But there's also a reason why there's gold.
Right. That's a good
universal
start. We'll give them a little kudos. But what would you say is really how much money in America is really protected by the FDIC anyway?
I mean, it's wildly speculated, Kerry, but I mean, there's many financial pundits out there that have calculated roughly 0.1% of all of the current deposits are covered by FDIC.
Got it. 0.1%. So in case you're kind of like hearing all this in the news and not really catching what's going on, guys, just real simple, interest rates and bond values have an inverse relationship. Okay. So, and why that matters is because institutions purchase long-term bonds. So institutions who have to make long-term commitments, okay, they buy long-term bond debt instruments to get that interest rate. So they bought so many of these at a low interest rate. Now interest rates have gone up. And so those bonds aren't worth much, because why would you pay full price for a bond that's paying 3% when you could get a bond that's paying 7% at regular price? So that's what's going on, is that these institutions, it's finally caught up now, that inverse relationship between interest rates and bonds, it's caught up on an institutional level.
Yeah, Kerry, what we're witnessing right now, in my humble opinion, is a 2008 type of layman's, scenario here that, we said this back in 2008, and essentially any fiat currency, whether that's dollar or euro or wherever, across the world here, every fiat currency is only valued at the confidence the consumer has in it. And you can see, Kerry, how fragile this system is, being fiat backed by nothing, right? And just the breakup of consumer confidence. Now we're seeing, bail-ins and bank runs, and I mean, it's all over the news right now, and it's pretty startling if you don't really understand the major background like you gave them, Kerry, of what's happening.
Absolutely. So that's what's going on. That egg is cracked. More dominoes are falling. Let's touch on what happened last night, Ryan.
Well, I mean, you look at last night, it's this domino effect. You have the Silicon Valley banks this last week. You had Credit Suisse, there in Europe. Now you're having Deutsche Bank.
Last night was Deutsche Bank.
Last night was Deutsche Bank, and same issues. Everything's being downgraded. There's bank runs. There's liquidity crises. All major deposits that are extremely, I call it leveraged to the hills, and it does not give the consumer that confidence that they want. Yeah, absolutely. So now our audience is financial advisors who are then, their audience is their clients, right? Right.
And so for you on watching this podcast today, let's talk about what's important to you and therefore your clients, because you're serving them. And so really, Ryan and I decided to do this podcast because it was really obvious that we needed to stand up and say, hey, instead of FDIC insurance, where a bank that's highly leveraged maybe and holds 6 or 7, 8 cents on hand for every dollar of liability, and then they stroke a premium check to an insurance company called the FDIC, instead of that and trusting in that so much, why wouldn't people trust in the long-term benefits of holding gold and silver? So that's why we're answering that question, which is better, FDIC or gold? Well, for the average consumer out there,
may have some of both, but the gold is what we found long-term is going to stick with you. So Ryan, unpack that a little bit for us on for our clients out there as financial advisors. This is a golden opportunity to get their attention.
Look at that pun, Kerry, the golden opportunity.
Right.
So, I mean, obviously having deposits inside of a financial institution, a bank, you want your working capital there. You want your safety nets there. You have to pay your bills via dollars, right? But having excess amount of capital inside of a bank, generating a measly return, it's not smart, So as an advisor, when you're looking at this as a golden opportunity, this is the time to be bringing this up to your clients, because this is all in the news for you. All the instability is already there for your client. I know in the last few weeks, Kerry, that we've seen this banking issue, the flow of volume into precious metals has been something I haven't experienced in my personal 17 years in this industry. The
That's
volume
right.
is off the charts.
And you know what, everybody, I've known Ryan for over a decade, and I've heard him make that statement, say the same statement several times in the last 5 years or so, especially. And so here we are again at that moment, Ryan, where you're seeing an unprecedented amount of flow and requests. And the crazy part is people on the other side of the purchase, I'll call it that instead of a trade, because we're not talking about securities. People on the other side of that are not letting go of their metals.
Well, do you blame them? Would you? I mean, unless you're in a financial circumstance that you need liquidity, in what world would you want to get rid of your insurance upon your wealth? Gold and silver acting as wealth insurance. So I mean, that 10 to 20% of clients' assets, we've been preaching this for, like you and I, Kerry, more than a decade now. This is really coming into play right now. Look at your FDIC. Why in the world would you have over $250,000 in a bank account doing nothing for you? It makes no sense. Yeah. The alternative savings account is your gold and silver. That's a real savings account.
Yeah, absolutely. So if you're unsure kind of how to bring this up, it's all in the training, how to position it, it's so easy. Like, the world continues, unfortunately, I'll even say, to serve on a silver platter, you as an advisor, the medium or the environment to easily bring this up. And, what do you think about this banking crisis recently, Yep. And so people still don't know that they have this as an option. And if they're in your world, and you have a connection to National Gold Consultants, or if you don't, you should get one. If they're in your world, then really, I would say you owe it to them to at least bring it up and have that conversation with them. Give them an opportunity, because the flip side of it, Ryan, is that they're getting bombarded with messages from the retail industry of gold and silver every day. And a lot of them are going to yield to that and go get it there. And we've unpacked it many times, but give them 15 seconds on what happens there.
Well, again, going back to the retail aspects of it, especially when consumers and your clients start to get emotional and to have the emotions in play here to make an irrational decision. Gold and silver is not an irrational decision to make, but it is if you jump into an arena that of all of these unknowns. A lot of these retail outlets, bait and switch, high commission, high premium, needs to be done in a sound financial manner to make sure a client does not make an emotional decision.
Yeah. So the last thing on my mind, and then you can talk about the last thing on your mind for this. The last thing on my mind, Ryan, is let's zoom out for a minute and look at what's going on macro cycle wise, secular, really secular bear market wise. We've had this massive downturn since the beginning of 2022, and it's really not gotten any better. Now we have this going on. It's all these systemic issues, all that arose from interest rates rising and just everything we've been through in the last several years. You've got automobile loans that are crazy underwater. Interest rates are super high. Tons of them are upside down. You've got commercial real estate. This is definitely not the shot that, it could be the kiss of death was already really hurting commercial real estate, all these different systemic things. And so my point of bringing this up, you guys, is to think for a minute, like, where's this all going? Like, we don't know exactly, but it sure doesn't look good. When you look at the Fed balance sheet right now and anytime you do stimulus at the same time you're trying to fight inflation, Those two things don't go together,
Right.
you know?
Yeah.
And so when you pump all that money in there, that's the very thing they haven't done to make the stock market recover. So think about it, 2009, 10, 11, 12, 13, 14, 2020, right? What did they do? They brought out the proverbial bazooka, printed money, and got the market back on track. Well, this time inflation was holding a lid on that, not letting them do that, right? So they're gradually raising interest rates, trying to curb inflation. Am I right or wrong, Ryan?
Yeah. I mean,
This is what's going on, right? And
double-edged
now
sword.
what has forced their hand on the stimulus? It's the banking industry.
Yep.
So now they're forced to do that. So my point is you really got to be talking to your clients these days about the next 5 to 10 years, what's going on, what does that look like? And where they have liquidity, where you maybe haven't already put them in an FIA or an annuity or life insurance plan, all of that liquid money really needs to be looked at again, you know, and then you can go back and do your calculation of 10 to 15% in physical metals. Then you've got some opportunity out there, even in the short-term traditional fixed annuity space, 3, 4, 5 years, paying 5%.
Right.
5% is not bad, you know? And so get that allocation done to gold and silver, talk to them about some of their other liquid money, and they're going to feel like that you're seriously thinking about what's going on in the world during their life, because that's all they care about. All they care about is during their lifetime, you know, this next in this next to 5 to 10 years is what I mentioned, because that's about as far as we can really plan out. That's the last of my thoughts, Ryan.
Yeah. One last thought I have, Carrie, because we're fielding 15 to 20, calls or emails a day right now from advisors asking about inventory availabilities, pricing, where things are at. And yeah, this is probably the hardest, inventory acquisitions that I've been experiencing in my last 17 years, because the demand is off the charts. The example for pricing I've been giving is, it really doesn't matter as long as you're able to find it from a trusted source right now, because pricing is all over the board. If it's a matter of finding product. So the example I've given, Carrie, is you go down to your local fancy restaurant, your chops and seafood, and you're getting the lobster tonight, and it says market price. Well, market price is what's happening on gold and silver right now. It's either you have it or you don't. And you got to make sure as an advisor, you're bringing your client to a trusted source that is not going to gouge somebody during these high volume type times. And I don't personally, Carrie, I don't see the high volume going away for any time soon. So buckle up and get in what you can at this time.
And as I always say, be the one who gets the credit for taking that to your client while you're protecting them at the same time, So don't miss this opportunity. Don't miss this responsibility, to talk to your clients. So have a great day, and we'll see you in the next podcast.
Yeah.